Wall Street landlords are dropping the rent. The real estate market in the United States has always been a profitable investment opportunity for many, including Wall Street homeowners. However, recent trends have shown a shift in the rental market, and landlords are facing new challenges. There has been a marked trend of declining rents by Wall Street landlords in various markets, leading to speculation about the causes and results of this sudden change. According to the latest data, about 10% of these landlords have reduced their rent by an average of 15% compared to previous years. This decline in rental prices has been observed in major metropolitan areas such as New York and San Francisco, where the rental market has historically been competitive and expensive. The pandemic and changes in work environments have significantly impacted the demand for rental properties, resulting in a decline in rental rates. Analysts suggest that the rental price decline resulted from a growing remote working culture as people began to leave urban centers for more affordable housing in suburban or rural areas. The shift has forced Wall Street homeowners to adjust their rents to attract tenants and maintain occupancy rates. Please support our channel with a thumbs up and don't forget to subscribe to our channel. The average monthly rental cost in the 50 largest cities in the United States is lower today than a year ago. During the pandemic, prices have dropped significantly in the Austin, Las Vegas, and Phoenix areas. According to Realtor.com, average rental prices in these cities are down 0.5% over the past year, after rents increased by nearly 25% from 2020 through most of 2021. This reduction is a crucial break for tenants. But this trend is not limited to residential buildings. Commercial real estate, including offices and retail space, are also experiencing lower rental rates due to reduced staff or remote work, causing many businesses to have extra office space. In response to the current economic climate, landlords in the Wall Street area have offered greater lease flexibility and reduced rental rates to retain their current tenant base while simultaneously attracting new ones. This initiative has been motivated by several factors that have led to increased competition within the real estate market. The pandemic. The substantial influence of the pandemic on the economy is widely acknowledged, and the real estate sector is a prominent illustration of this paradigm shift. Due to a significant number of individuals facing job losses or encountering reductions in their income, there has been an elevated requirement for cost-effective housing options to be within financial reach. Many people have been forced to downsize or find more affordable housing options. As a result, a surplus of rental properties have become available, leading to a decrease in prices. Remote work ratio. Many individuals have departed from urban cities characterized by high living costs, primarily attributed to the increasing prevalence of remote work. Empowered by the option to work remotely, individuals have realized that the necessity to endure exorbitant rents or inhabit constrained living spaces is no longer imperative. The outcome of this phenomenon is that as an increasing number of individuals relocate, the demand for housing within these high-cost urban cities experienced a decline. Property owners have astutely discerned this pattern and acknowledged the imperative to recalibrate rental pricing to sustain occupancy rates. Consequently, many landlords have strategically reduced rent prices, rendering them more accessible and appealing to prospective tenants. The recent rise in remote work has noticeably impacted the housing market, allowing people to reside in conveniently located areas without compromising their professional growth. This trend has resulted in a considerable shift, allowing countless individuals to avoid the frustration of expensive urban living arrangements. Therefore, if you are grappling with the burden of unaffordable rent payments, this might be an opportunity to take advantage of the available options and relocate to a new place. High mortgage and interest rates. When mortgage and interest rates are high, it becomes difficult for investors to get financing for their rental properties. In addition, rental costs are rising steadily in many major cities in the Midwest and Northeast. For example, in Columbus, Ohio, rental prices rose 9.3%, the highest of any city. Similarly, rents increased in New York by 6.8%, Pittsburgh by 3.8%, and Boston by 3.3%. Realtor.com suggests this may indicate a stronger job market in these regions than in the South and Southwest. Thus, it affects the profitability of real estate investors, resulting in shifting rental rates. Increasing property taxes. Another reason behind the decision of Wall Street landlords to reduce rental rates is the escalation in property taxes. This increase in property values directly correlates with a corresponding rise in the obligatory property tax payments for landlords. These additional costs affect their rental income, forcing them to adjust their rent to maintain profitability. With property taxes still rising in many areas, landlords have no choice but to adjust their rent. Oversupply of rental housing. The oversupply of rental housing is another problem facing Wall Street realtors. According to the latest data from the U.S. Census Bureau, there are about 17 million rental housing units in the United States. The abundance of rental properties causes rental prices to fall because landlords are trying to attract tenants. It's worth noting that many of these cities are known for their tech industry, which has been hit hard by recent job losses. Due to the increasing number of new apartments and the need to remain competitive, Wall Street property managers have reduced rental rates. The case of Austin landlords. In cities like Austin, Texas, landlords are experiencing the impact of lower rents. Austin has experienced significant population growth, which has resulted in an influx of new rental properties into the market. The increase in supply has driven down rental prices and made it difficult for Austin homeowners to maintain profitability. As a result, many of them are now facing the decision to sell their rental properties. The impact of increasing vacancies in Las Vegas. Las Vegas has seen a growth in the number of vacant rental spaces, with the share of vacant space increasing from 2.5% to 8.7%. Because of the oversupply of rental properties, landlords are facing fierce competition and deciding to reduce rental prices. As a result of this sudden increase in vacancies, many Las Vegas landlords are finding it challenging to find tenants and maintain their rental income. The 30-year fixed mortgage rate has risen above 6% for the first time since 2008 and will continue to do so. With the increase in mortgage rates, we can anticipate a significant slowdown in the housing market. Before the rise in interest rates, market growth was unsustainable. As a result, the Federal Reserve purposefully raised interest rates to curb the housing market that had become overpriced for many. The prices of single-family homes have decreased, accompanied by a decline in the number of homes sold. Moreover, there has been a noticeable decline in the number of homes available for sale in recent months. In the event of a sudden and substantial increase in inventory, it would indicate the probability of home prices plummeting in 2023. Nevertheless, at the present moment, we have not observed such a significant surge in inventory. In the past decade, homeowners have enjoyed mortgage rates below 4%. However, this favorable situation has posed a challenge for certain sellers who find it difficult to justify selling their current homes, given that they would have to purchase another property at a significantly higher interest rate. As a result, a growing number of people are opting to delay buying and selling homes, ultimately leading to a noticeable decline in both the supply and demand of properties. With the current problems in the rental market, the question arises, will Wall Street homeowners sell their properties? The answer is most likely yes. Rising borrowing costs, higher property taxes, and an oversupply of rental housing are putting significant pressure on landlords' profitability. Consequently, numerous investors might contemplate selling as a viable strategy to mitigate their losses and reallocate their investments to alternative options. According to an analysis by Associate Professor Brian Ahn of the Georgia Tech School of Public Policy, many large firms that purchased thousands of homes in the Atlanta area after the Great Recession were responsible for much of the decline in home ownership. There are indications that corporate property purchases are experiencing delays in several high-growth markets, such as Charlotte. Redfin reported that the number of homes bought by investors in the urban areas decreased by nearly 50% in the first quarter of 2023 compared to the previous year. In Charlotte, the only North Carolina metro area looked at by Redfin, the percentage of homes purchased by investors decreased by 66% compared to the previous year. This decline in investor buying is similar to what happened in Atlanta, where both cities experienced declines in investor purchases across the country. The study primarily concentrated on the Atlanta area, but its findings could have a notable impact on markets such as Charlotte and Raleigh. These cities have experienced a rise in home buying from big corporate firms supported by Wall Street. An investigation conducted in 2022 by the Charlotte Observer and the News and Observer uncovered that around 24 national corporations owned over 40,000 single-family homes in North Carolina, with a majority of them concentrated in the state's urban areas. Conclusion: The evolving U.S. housing market is significantly affecting Wall Street landlords, with declining rents, increasing property taxes, and a surplus of rental housing compounding their challenges. Mounting pressures on profitability have led numerous landlords to contemplate lowering rents or selling their rental properties. The ongoing market transformation prompts curiosity about these landlord strategies for adapting to these new circumstances. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.